Welcome back to the deep dive. Today, we are not just doing a deep dive. We are doing a forensic investigation.
That feels about right.
We're tackling the monster under the bed, or maybe more accurately, the monster in the mortgage. We are talking about the housing market.
It is the topic. It's the one that dominates every dinner party, every group chat, and certainly a lot of sleepless nights right now.
It really is. And I have to be honest with you, before we started prepping for this, I was feeling that anxiety myself.
Of course.
If you just glance at the headlines, it looks like a horror movie poster. You've got words like crash, bubble, foreclosure tsunami, and then the classic villain, Wall Street is buying your neighborhood. It's terrifying.
And it feels relentless.
Absolutely relentless.
It's designed to feel relentless.
Yeah.
The fear drives engagement. But our mission today is to cut through that noise. And I want to be really clear about what we're doing here. We aren't just looking at Zillow listings and, guessing. We have a massive stack of sources. We're talking academic papers from the IMS, machine learning studies from our SKIF, policy briefs from the Mercatus Center, and even boots-on-the-ground podcasts from real estate veterans.
We're going to look at the math, not the myth.
That's the goal.
And here's the hook, the thing that really grabbed me when we started digging into this stack. We saw some recent polling suggesting that nearly half of Americans blame investors for high home prices.
Right, the Wall Street narrative again.
Exactly. They think it's a conspiracy. They think the game is rigged. But the data we have here tells a completely different and honestly a much more complex story.
It really does. And that's why we need to frame this carefully. This isn't just about will prices go up or down next month.
That's the wrong question.
It's totally the wrong question. It's about fundamentals. It's about supply, demand, human behavior, and understanding the mechanics of what is actually happening. Because knowledge is only valuable if you can apply it.
Exactly. Okay, let's unpack this. Because I feel like everyone I know, myself included, is in this state of paralysis. They're asking, are we in a bubble?
The big one.
Why are prices still so high if interest rates went up? And the classic, should I rent or should I buy? It feels like there are no good answers, just bad options.
Those are the core questions. And to answer them, we have to start with the scariest word in real estate. The word that brings back all the trauma of 2008.
The B word, bubble.
The B word. Everyone is scarred by it. We are constantly scanning the horizon for the next crash. But here's the thing.
What's that?
To know if we're in a bubble, we have to actually define what a bubble is. You can't just say, prices are high, therefore it's a bubble.
Right. High prices are painful, but they aren't necessarily a bubble. And this is where we found some fascinating research from the International Monetary Fund, the IMF.
Yeah, this was really interesting stuff.
They don't just guess, they have a very specific methodology.
They do. They reference research pioneered by a guy named Peter Phillips. And you can think of it like a medical test for the economy. They're looking for a specific condition they call exuberance.
I love that term, exuberance. It sounds like a party. It sounds fun.
It does.
But in economics, it's a very bad thing.
It's a very bad thing.
In this context, a bubble is defined specifically as when an asset's price exceeds its intrinsic value, driven purely by expectations of future appreciation.
So speculation.
It's pure speculation. It's FOMO, fear of missing out. People buying just because they think it will be worth more tomorrow, not because the asset itself, justifies the price based on what it can generate in rent or based on local incomes.
So how do they measure that? How do you take the blood pressure of the housing market to see if it's exuberant?
Okay, so they look at a few key indicators, and you have to look at them in a specific order. First, you have to look at real house prices.
Meaning adjusted for inflation. Exactly. This is crucial because if you just look at the price tag, the nominal price, you might get confused by general inflation in the economy. Things just cost more everywhere.
Like those examples they gave from a few years back in Croatia or Israel.
Right.
It looked like a housing boom. Prices were just shooting up. When they dug in, it was really just currency inflation. The house wasn't worth more. The money was just worth less.
Precisely. So you have to strip that out first to get a clear signal. But that's just step one. The more important metric, the one that really signals a problem, is the price-to-income ratio.
The affordability metric.
That's the one. If house prices are skyrocketing but incomes are flat, that gap, that is exuberance. That's a strong signal of what they call a non-fundamental bubble, because eventually people literally cannot pay for the homes. The math just stops working.
And then there's a third one I look at, the price-to-rent ratio.
Right. Think of this like the PE ratio, price-to-earnings ratio. In the stock market, it's a valuation metric.
Okay, so if the price to buy a house is massively higher than the rent you could get for it, it suggests people are speculating.
Exactly. They aren't buying for the utility of the home or the income it generates as a rental. They are buying for the flip. They are banking on the greater fool theory that someone else will come along and pay even more later for no good reason other than momentum.
So looking at the IMF data for right now, or, for the recent post-pandemic period where prices felt like they just went to the moon, are we in the red zone? Are we exuberant?
And this is where it gets surprising. It really contradicts a lot of the doom-scrolling narrative you see online.
Okay, lay it on me.
The pandemic boom was intense. Absolutely. Prices shot up. But according to the IMF sources, that exuberance was actually quite short-lived.
Short-lived. It felt like it lasted forever. It felt like every single month prices were up another 10%.
It felt that way. But the data shows that the strict lending regulations, all the stuff that was put in place after 2008, like Dodd-Frank, they actually worked. They limited the price-to-income exuberance. The IMF noted that while real prices jumped up, that dangerous disconnect between price and income was limited to only a few countries.
And which countries were those?
They listed Portugal, the Netherlands, and Germany as flashing red on that specific metric.
And not the U.S.
The U.S. largely avoided that kind of exuberance in the price-to-income ratios. Now, I want to be nuanced here.
Please.
The price-to-rent ratios did flash some warnings in the U.S. Buying became significantly more expensive than renting in a lot of places. But the income support was there in a way it just wasn't in 2008. People could actually afford the mortgages they were signing, even if the prices were painfully high.
So the blood pressure is high, but the patient isn't necessarily having a heart attack. It's more like they just ran a marathon and are really winded.
That's a decent analogy. The fundamentals are stretched, for sure, but they aren't broken by pure speculation in the way they were back then.
Okay.
But speaking of predicting heart attacks or economic heart attacks, we have to talk about this paper from Arkirov.
Oh, man, this one.
The one by Plakandaras and his colleagues.
Right.
This is where we get into the heavy technical machinery.
This was the machine learning paper. I tried to read the methodology section and my eyes crossed a little bit, but the model name is impressive. The EMD SVR model.
Ensemble Empirical Mode Decomposition with Support Vector Regression.
Bless you.
Thank you. It's a mouthful, but the concept is fascinating, and it's worth spending a few minutes on because it really challenges how we usually think about economics.
Okay, break it down for me. Like, I'm 5. What is empirical mode decomposition?
Okay, imagine you're listening to a song. You hear the drums, the bass, the vocals, and the guitar all at once.
Right.
That's the price of housing. It's a messy mix of a lot of different signals. You've got inflation, seasonal trends, long-term supply issues, short-term speculation. It's all jumbled together. Empirical mode decomposition is like a sound engineer isolating those tracks. It breaks the messy signal of housing prices into its different frequencies or modes.
So it separates the noise from the actual, melody line, the real signal.
Exactly. It separates the short-term noise from the long-term trend. And then, once they have those clean signals, they feed them into a support vector regression.
Which is?
It's a type of machine learning algorithm that is really, really good at finding patterns that don't fit a straight line. It's designed for complex, nonlinear relationships.
And why is this better than what economists usually do?
Well, a lot of standard economics relies heavily on linear models and this idea of the efficient market hypothesis, the idea that you can't really predict the market because all information is already baked into the price.
They assume everyone is a rational actor.
Right. This paper says no. The market is messy, nonlinear, and emotional. It's not rational. And they built a tool to measure that messiness.
And the results were pretty shocking.
They were stunning.
They claim this model successfully predicted the 2006-2009 housing downturn 2 years in advance.
2 years. Think about that. Imagine the difference that knowledge would have made if policymakers had a dashboard flashing red in 2006 saying the underlying trend has broken. Maybe they could have acted. It's incredible.
That's a huge claim.
It is. But what is even more profound for us, sitting here today, is the implication of their findings. The model suggests that housing prices are a leading indicator for the entire business cycle.
So housing sneezes, and the rest of the economy catches a cold.
Precisely. A drop in housing often signals an economic contraction before it shows up in the GDP numbers or unemployment figures. So if we're looking at today's market, we aren't just worried about our home equity. We are, in a sense, looking at the tea leaves for the entire economy.
If housing rolls over, a recession often follows.
That's what their work suggests. which puts a lot of pressure on understanding what the housing market is doing right now.
Okay, so if the machine learning models are the crystal ball, what are the boots on the ground people saying? We listened to their economy podcast from First American, and they seem to have a different take on the whole crash versus correction debate.
They do. And this is a really vital distinction to make. Mark Fleming and Odeta Cushy, the hosts, they make a strong case that what we're seeing right now is a deceleration or a rebalancing, not a crash.
But wait, explain the difference. If prices go down, isn't that a crash? To the person seeing their home value drop, it feels the same.
I get that, but not necessarily. A crash is a rapid, systemic loss of value, usually driven by panic selling and forced liquidations, like foreclosures.
Okay.
A correction, or rebalancing, is a slow adjustment to new conditions. They pointed out that annual price appreciation has slowed to the lowest rate since 2012.
Slowed, but not, reversed everywhere.
That's the key. In 2008, the bottom fell out everywhere. Miami, Vegas, Phoenix, Des Moines. It didn't matter where you were.
The whole system was infected.
The whole system.
Mm-hmm.
Right now, we're seeing a split market.
Yeah.
You have markets like San Francisco or Tampa or Austin that are seeing declines, which makes sense. They were the most overheated.
Yeah.
But then you have more affordable markets like Cleveland or Louisville that are still seeing modest growth.
That feels less like a bubble popping and more like gravity taking over in the places that went to the moon.
It's the market adjusting to higher interest rates. It's late cycle behavior. It's boring, actually, compared to a dramatic crash. But boring is good for stability.
Okay, so if it's not a speculative bubble and the blood pressure is high but stable, we still have to answer the big question. Why are prices so high? If rates are up, prices should come down, right? That's Econ 101.
It is.
If it costs more to borrow money, people can afford less house, so sellers should have to drop their prices to meet the buyers.
That is Econ 101, but the real world is currently giving us an Econ 404, file not found error, because we are missing one huge, massive variable in that equation.
And that is. This brings us to the Mercatus Center policy brief. And honestly, this was the part of the research that really changed my worldview on this whole topic.
It's a paradigm shift.
I always thought the problem was money, too much, cheap money, greedy banks, that sort of thing. But they argue the root cause isn't overbuilding or excess credit. It's what they call closed access cities.
This is a critical theory by an economist named Kevin Erdman, and it flips the script. The narrative we are all told is that the 2008 crisis and our current prices were caused by excess. Too many houses, too much credit.
The McMansion story.
Exactly. Erdman argues the opposite. He says the U.S. has been chronically, systemically undersupplied with housing for decades.
Undersupplied. And he points the finger at specific culprits. New York, Los Angeles, Boston, San Francisco.
The closed access cities. Think about those places.
Yeah.
They have the highest incomes, the best jobs, the most economic productivity. But for 30, 40 years, they have had incredibly restrictive zoning laws and endless bureaucracy.
You can't build anything. My brother lives in LA, and getting a permit for a deck is like a 2-year process.
Exactly. You can't build up. You have height limits, historical preservation districts, community review boards that can block anything for any reason. So what happens?
Prices go up.
You get a flood of high-income people wanting to live there for the jobs, but you get a trickle of new housing. So all that high income goes straight into bidding up the price of the existing homes and apartments. It acts like a wealth pump, transferring money from workers to landlords and existing property owners.
And eventually it prices out everyone else. Normal people, teachers, firefighters, baristas. They can't live in San Francisco anymore.
Exactly. And here is where it gets really interesting and tragic, really. This created what Erdman calls the contagion effect. Because people couldn't afford to live in LA or San Francisco, they left. Not because they wanted to, but because they were economically forced out.
They became housing refugees.
That's a great way to put it.
Yeah.
And where did they go? They went to the contagion cities, Phoenix, Las Vegas, inland California, parts of Florida.
Right. And looking back at the 2000s, it looked like Phoenix was overbuilding. There were cranes everywhere. It looked like a classic bubble.
It did. But Erdman argues they weren't overbuilding for the local Phoenix economy. They were trying desperately to absorb a refugee crisis from California's failed housing policy.
That puts a completely different spin on the bubble of 2008 in those areas.
It changes everything. And it explains why the crash happened the way it did. When prices in Phoenix got too high, or when the national economy wobbled, that migration from California stopped. The refugees stopped coming. Demand collapsed instantly. And suddenly, yes, Phoenix had too many houses.
But not because they built too many for a normal market.
Right. It was because the artificial demand that was propping them up got cut off at the source.
So the root cause wasn't the subprime lenders in Phoenix, it was the zoning boards in San Francisco.
In a large way, yes. And that brings us to today. Because we never fixed that fundamental problem. In fact, it's gotten worse.
So let's look at the numbers for right now. The current supply stats from Luminate Bank and some of the data Blackstone puts out are just staggering.
They are.
Yeah.
Get this. The U.S. population has nearly doubled since 1960.
Doubled. Okay.
But housing starts, the number of new homes we are building each year, is roughly the same as it was in 1960.
That can't be right.
It is.
It is.
That is a mind-blowing statistic. Let it sink in. We have double the people, but we are building the same number of houses as we did when Eisenhower was president.
And Luminate Bank points out that listing levels, the number of houses for sale right now, are still down something like 42% compared to pre-pandemic levels.
So we have a decades-long structural shortage, and on top of that, we have a short-term inventory crunch. It's not a bubble of air. It's a vacuum. There's just nothing there.
And when you have a vacuum, it sucks prices upward. It defies the gravity of interest rates because people need somewhere to live.
That is the core of the problem.
Okay, so we've established it's a supply problem, but there is a very loud, very angry narrative out there that says, no, there are plenty of houses, but they own them all.
Ah, yes. The villain of the story.
The institutional investor, the Wall Street owns Main Street narrative. We see this everywhere. I see it on TikTok daily. Some guy standing in front of a house screaming that BlackRock is buying 25% of the homes, outbidding families with cash and driving up prices.
It is a very convenient narrative. It's powerful. It gives us a clear face to blame. It's a lot easier to be mad at a faceless hedge fund than it is to be mad at a zoning board meeting that happened in 1995.
True. But we pulled reports from Jay Parsons, who analyzes rental housing economics, and even data directly from Blackstone to look at the actual numbers.
Right.
The myth does not hold up to the math. Not even close.
Let's hit them with the numbers, because that 25% number is the one everyone throws around.
Right. And that 25% figure is usually a wild misinterpretation. It's often investor purchases in a specific hot market for one quarter, and they lump in everyone from a massive hedge fund to a guy buying a second home to use as an Airbnb.
So it's not Wall Street.
It's not. If we look at actual ownership, who actually owns the single-family homes in America? Institutional investors, and they define that as companies owning 1,000 or more homes, own 0.5% of all single-family homes.
0.5%.
Half of 1%. There are roughly 140 million housing units in the U.S. These large institutions own about 700,000 of them.
It's tiny. That is a rounding error on a national scale.
It is. Blackstone specifically, who is often the face of this because they're the biggest name, they own about 0.06%.
So if you passed a law tomorrow that said BlackRock cannot own any single-family homes, it would essentially change nothing on a national level.
It would put a tiny fraction of homes back on the market, but it wouldn't dent prices. In fact, get this, if you look at market activity, who is buying right now, in the second quarter of 2025, large institutions were actually net sellers.
Wait, they're selling, not buying.
They are selling. They sold nearly 6,000 homes and only bought about 4,000. They are leaving the market, not cornering it.
Why?
The yield isn't there for them anymore because prices are so high it doesn't meet their return thresholds. So who are the investors that people see buying houses? Because people do see investors buying homes in their neighborhoods. I've seen the "We buy ugly houses" signs. That's a real thing.
It's totally real.
Yeah.
But those are overwhelmingly mom and pop investors.
Mm-hmm.
People who own between 1 and 9 properties. Maybe it's a doctor who owns 3 rental units or a small local LLC that flips 5 houses a year. They account for about 20% of sales.
A much bigger slice of the pie.
A much bigger slice, but they're not Wall Street. The boogeyman is statistically insignificant in the grand scheme of ownership.
But what about the bidding wars? The story is always, I made an offer on my dream house, and a corporation came in with an all-cash offer and paid $50,000 over asking.
That happens, but it's usually not with the big institutional investors. You have to think about their business model.
Okay.
They are obsessed with yield return on investment. They have shareholders and algorithms to answer to. If they overpay in a bidding war, they destroy their profit margin from day one. It just doesn't make sense for them to pay over market value.
So what are they buying? What's their target?
They have a very specific buy box, as they call it. They target homes that need significant repair. We are talking $30,000 to $40,000 in renovations. The kind of houses that, smell like cat pee and have 1970s shag carpet and a leaky roof.
The houses that a first-time homebuyer walks into and immediately runs away screaming from.
Exactly. Or More importantly, the houses a first-time buyer literally cannot finance.
What do you mean?
Government-backed loans like FHA loans have strict requirements about the condition of the home. You can't get a standard mortgage on a house with a hole in the roof or a missing kitchen or major electrical problems.
So regular buyers are locked out of those broken homes anyway.
Pretty much.
Yeah.
Institutions can come in with cash, fix the roof, put in a new kitchen, and then rent it out. The Urban Institute data backed this up completely. They showed institutions spend significantly more on renovations than a typical homeowner, about $39,000 versus roughly $6,000.
So in a way, they are acting as a renovation engine for the aging housing stock.
You could see it that way, yes. They are capitalizing the repairs that many individual owners can't afford to make.
But there's still that argument, the moral argument. If investors didn't buy these homes, renters could buy them. The idea that every rental home is a stolen homeownership opportunity.
It sounds logical, and emotionally it really resonates with people. But it ignores the credit cap. And this is the uncomfortable truth about the American consumer right now.
Uncomfortable is right. Lay it out.
The average credit score for a renter living in a single-family rental is under 660. The average credit score for a first-time home buyer is over 720. There's a 60-point gap there.
That's a significant gap. That's the difference between getting a loan and not getting one.
It's a huge wall. And it's not just credit scores. Even high-income renters, and we're talking households making $130,000 a year, often can't qualify for a mortgage.
Why not? If they make $130K a year, they should be able to buy a house.
Debt-to-income ratios. They have huge student loan payments, car payments, credit card debt.
Uh-huh.
Or they just don't have the $50,000 in cash for a down payment and closing costs. So if you banned investors tomorrow, those renters wouldn't suddenly become buyers.
They'd still be renters.
They would still be renters, but there would be fewer and likely lower quality rental houses available for them.
So the research suggests that if you banned institutions, those homes would likely just be bought by smaller investors, the mom and pops, or they would just sit on the market longer until a flipper picked them up.
Exactly. It wouldn't magically create a nation of homeowners without addressing the root problems of credit, savings, and, of course, supply.
Okay, so the villain isn't Wall Street. The problem is supply. But let's talk about the other big fear, the fear that it's all about to collapse anyway. The foreclosure wave.
The YouTube specialty.
Seriously, there are entire channels dedicated to predicting a tsunami of foreclosures that will crash the market. They show these scary-looking charts of foreclosures start spiking up.
And they get a lot of views because it taps into that 2008 anxiety. But again, let's look at the data from First American and the Denver Investment Real Estate podcast. They debunk this pretty effectively just by adding context.
They point out that foreclosure starts are up year over year. That part is true.
They are up, yes. But you have to ask the critical question. Up from what? They are up compared to the foreclosure moratoriums of the pandemic when it was literally illegal to foreclose on anyone.
So of course they're up from zero.
Of course. But the real comparison is to a normal market. And they're still down about 18% compared to 2019.
And 2019 was a normal, healthy, pre-pandemic market.
Exactly. We are still below normal levels of housing distress.
But what protects us? Why aren't people losing their homes if inflation is so high and things are so expensive?
It's the safety net. And I don't mean a government program, I mean home equity. U.S. households are sitting on a record $36 trillion in home equity.
$36 trillion. That is a number I can't even visualize.
It's an enormous financial buffer, and you should explain why that matters so much for foreclosures.
Well, foreclosure is a last resort. It happens when two things go wrong at the same time. You lose your income, and you have no equity, meaning the house is worth less than the loan you owe on it. That's what happened in 2008. People were underwater.
Right. But today, you lose your job, or you get divorced, or you have a medical emergency, but you have $100,000 in equity. You don't let the bank foreclose.
No way.
You call a realtor, you put the house on the market, you sell it, you pay off the loan, and you walk away with the check for your equity.
So it's a regular sale, not a foreclosure. It adds a little supply to the market, but it doesn't crash the market with distressed bank-owned assets.
Exactly. For a wave of foreclosures, a real tsunami, we would need a dual shock. Mass unemployment to cause income loss, and a massive drop in home values to wipe out that equity happening at the same time. Right now, we have low unemployment and record high equity. The math just isn't there for a tsunami.
There are pockets of distress, though. We shouldn't ignore that completely.
Always. You can see it in the data. FHA and VA loans are showing some stress because those borrowers are typically more leveraged and more vulnerable to inflation. And you see specific markets, the example they used was Cape Coral, Florida, that are struggling.
Insurance, right?
Skyrocketing insurance premiums and softening local economies.
Right.
But pockets do not make a wave. It's localized pain, not systemic failure.
Okay, but what about a recession? If that machine learning model is right and housing is predicting a downturn, doesn't a recession mean housing prices will crash? I think everyone just assumes that. Recession equals housing crash.
That is the biggest myth of all. And it's purely because of recency bias from 2008. We are all scarred by that one event.
So history says otherwise.
History says otherwise. In 4 out of the last 5 recessions, home prices actually increased.
Wait, what? Increased? How is that possible? People have less money and are losing their jobs in a recession.
Because 2008 was the anomaly. 2008 was caused by housing collapse. It was a housing-led recession. But normally, think about the mechanism. In a typical recession, the economy slows down. What does the Federal Reserve do?
They cut interest rates.
They cut rates to stimulate the economy. Lower interest rates mean cheaper mortgages. Cheaper mortgages mean more purchasing power for home buyers. So demand for houses often goes up during a recession, which supports prices.
That is wild. We are so traumatized by 2008 that we think the exception is the rule.
Exactly. So if we do hit a recession in the next year or two, it might actually unfreeze the market rather than crash it.
And that leads us to the most unique and, frankly, the most frustrating dynamic of this current market. The thing that is making everyone miserable. The lock-in effect.
I prefer to think of it as an inventory strangulation. Luminate Bank and Chad Wilson discussed this. Millions and millions of Americans have a mortgage rate under 4%. Many are under 3%.
Oh, yeah. I have friends with 2.7% rates. They brag about it constantly. But they also say they are never, ever moving. They feel trapped.
It's the golden handcuffs. Just think about the math for a second. If you have a $400,000 mortgage at 3%, your principal and interest payment is roughly $1,700.
Okay, that sounds nice.
Now, let's say you want to move, and you buy a new house that costs the exact same amount, $400,000, but your new rate is 7%.
Oh, man. I'm doing the math in my head. It's a lot more.
Your payment goes to about $2,600 or $2,700. You are paying $1,000 more every single month for the exact same value.
So nobody sells.
Nobody sells unless they absolutely have to. Death, divorce, a major job relocation. But all the discretionary moves, that I want a bigger kitchen or we need a home office, moves, those are dead.
Which means no supply hits the market.
Exactly. Even if demand softens because rates are high, supply is down 42% because of this lock-in. It creates a standoff. Prices are sticky because the sellers are on strike.
And they made a great point about the future. Everyone is sitting around waiting for rates to drop so houses get cheaper.
But that might completely backfire.
Explain that logic. It seems counterintuitive.
If mortgage rates drop just 1%, say from 7% to 6%, it brings millions of buyers back into the market who are priced out. They can suddenly afford the monthly payment, but does a 1% drop bring the sellers back?
Probably not. If I have a 3% rate, a new 6% rate still looks terrible.
Exactly. The buyers might come back to the market much faster than the sellers. So a rate drop could actually increase competition for the few homes available and push prices up even further.
That is the nightmare scenario for buyers. You wait for relief, and all you get is more competition.
It's a very real possibility in this supply-constrained world.
Okay, so let's get practical. This is a lot of theory. We have listeners right now who are renting and feeling like they are throwing money away. We have listeners who want to buy but are terrified. What do we tell them?
First, we need to address that phrase, throwing money away on rent. This is one of the most toxic and, frankly, inaccurate ideas in personal finance. The National Multifamily Housing Council, or NMHC, has some strong words about those online rent versus buy calculators.
They call them culturally biased.
And mathematically flawed. Let's do a real deep dive on the map here because it's important. Most of those calculators automatically assume you will get a big tax break for buying a house. The mortgage interest deduction.
Right. Everyone says buy a house. It's a great write-off.
But thanks to the tax changes a few years ago, the standard deduction is now quite high. For a married couple, it's almost $30,000.
Meaning, unless your mortgage interest, state and local taxes, and other deductions add up to more than $30,000, you don't itemize, you just take the standard deduction.
Exactly. And in reality, only about half of homeowners itemize their taxes now. So for 50% of people who own a home, they get zero tax benefit from their mortgage interest. None. It's just an expense like rent.
But the online calculators usually default to assuming you get those savings, which makes buying look better than it is.
Right. They overstate the benefit of buying. But the bigger flaw is that they almost always ignore opportunity cost. This is huge.
But walk me through the opportunity cost calculation.
Okay, say you are buying a $500,000 house and you put $100,000 down, a 20% down payment. That $100,000 is now trapped in the walls of your house. It is illiquid equity. It's not due anything but sitting there.
It's securing the loan.
Right. But what if you rented instead and you took that same $100,000 and put it in a simple S&P 500 index fund? Historically, that money grows at 8 to 10% a year, compounded. Over 30 years, that initial $100,000 becomes a massive pile of cash.
And the calculators completely ignore that potential growth.
Usually, yes. They treat the down payment as money that's just spent in the rental scenario, rather than invested. If you run the numbers honestly, including the lost investment growth, the 1–2% per year in maintenance, the rising insurance costs renting, often comes out ahead purely on a financial basis.
Especially when you factor in the unsexy costs, the maintenance.
Oh, absolutely. The rule of thumb is 1% to 2% of the home's value per year in maintenance and repairs. So on a $500,000 house, that is $5,000 to $10,000 a year you should be setting aside every single year.
For the new roof, the broken water heater, the tree that falls on the fence.
All the stuff that, when you rent, is the landlord's problem. When you buy, it is your problem, and it always seems to happen at the worst possible time.
I heard a great quote once. Rent is the maximum you will pay for housing each month. A mortgage is the minimum you will pay.
That is the perfect framing. So renting isn't throwing money away. It's buying flexibility. It's capping your housing liability. It's a perfectly valid financial choice.
I love that. But let's say someone weighs all that and decides they do want to buy. You know, they want the dog, they want to paint the walls, they want that stability, or maybe they need to sell in this weird market. We found some great tips from the Austin Real Estate Guru podcast.
Lisa Marie Contaldi.
Yeah.
She had some very specific, tactical advice that I thought was brilliant.
She said for buyers, her #1 rule was, don't wait for the bottom.
Because trying to time the market is a fool's errand. We just discussed how rates dropping could actually raise prices. If you need a house and you can comfortably afford the payment right now, buy the house. Her line was, marry the house, date the rate.
I like that.
You can always refinance later if rates drop significantly. But if you wait for the perfect time, you might wait forever and just watch prices rise.
And for sellers, she had this concept of savvy renovations, not doing a full $80,000 kitchen remodel, but focusing on specific small things.
This was great. She focused on high-impact, low-cost, things that signal value and well-maintained to a buyer without costing a fortune. She mentioned front door hardware.
A shiny new handle. It seems so small.
It sounds trivial, but think about the psychology of a home tour. The very first thing a buyer touches is the front door handle. If it's loose, tarnished, or sticky, their subconscious immediately registers. This house is old. The owners didn't care.
It signals deferred maintenance.
Exactly. If the handle is crisp and new and solid, the house feels solid from the first second. It's a tiny investment with a huge psychological payoff.
And grout. She was obsessed with grout.
Cleaning or bleaching the tile grout. Nothing makes a bathroom look older and dirtier than yellow or black grout lines. A bottle of bleach costs $3. A new bathroom costs $30,000. It's the best ROI in home improvement. Scrub the grout.
And the last one was lighting.
Designers never miss lighting. It changes the entire vibe of a room. She said to swap out the old dated fixtures, especially the boob lights, you know, the ones, for something modern and clean. These are things that cost hundreds, not thousands, but they make a home feel current and desirable.
So we have covered a massive amount of ground here. We have popped the bubble myth with the IMF data. We have exposed the decades-long supply shortage and the closed access cities. We exonerated the institutional investors for the most part. We debunked the foreclosure wave.
That's a lot to digest.
It really is. So let's bring it all home. What does this all mean? If you had to summarize the state of the market for our listener who's been with us this whole time, how would you synthesize this?
I would say the market is confusing because it's broken in a completely new way. It's not a boom and bust cycle right now. It is a frozen cycle.
Frozen.
Inventory is stuck. It's frozen because of the lock-in effect. Demand is suppressed. It's frozen because of high rates. But underneath it all, the demographic need, the millennials, the Gen Zs who are aging into home buying years, that demand is huge. And it's real. It's just waiting.
My aha moment in all this was realizing that the villain isn't a person or a corporation. It's not BlackRock, and it's not a speculative bubble. It's a decades-long failure to build. We simply stopped building enough housing in the places where people want to live and work.
And in many cases, We made it illegal to build in those places through restrictive zoning. That is the villain. We collectively chose this outcome over decades of policy decisions.
So here is where it gets really, really interesting, and I want to leave the listener with this final thought to chew on. We spend so much time obsessing over housing as a financial asset. Will my home value go up? Will it go down? Is it a good investment?
Right, the personal finance angle.
Exactly. But go back to that machine learning paper. If they are right, if housing is the canary in the coal mine for the entire economy, and right now our housing market is frozen, undersupplied, and locked up, what does that predict for the next 10 years of American economic life?
That is the provocative question, isn't it? If the primary leading indicator of the business cycle is stagnant and sclerotic, are we locking in a decade of economic stagnation? Are we choosing slow growth and lower productivity by refusing to build housing where the jobs and opportunities are?
It's a heavy thought. We might be choking off our own economic future by protecting the value of our existing homes.
It's very possible that the price of high home values is a less dynamic economy for everyone.
But hey, on the bright side, at least we aren't facing a foreclosure tsunami, so that's good news.
Small victories.
Thank you for diving deep with us today. Our advice: check your biases, look at the data, don't yell at the guy fixing the "We Buy Ugly Houses" sign, and we will see you next time.
Take care.